Yeah, I think there's a few months of people thinking they might slow down the train and they're realizing that they're not going to. And now we're kind of back on all steam ahead. Nothing stops his train. I refer to basically Walter White from Breaking Bad, where, his allies are trying to get him to stop his drug empire. And he's like, no, nothing stops his train. Yeah. We're going to keep going. And I think the U.S. fiscal deficits are the same. There's extremely low probability that any time in the next 5 to 10 years that they're going to meaningfully make reductions in the U.S. fiscal deficit. There's a bunch of reasons for that. And that has all sorts of geopolitical implications, investing implications, economic implications. And, sometimes people will phrase that as a doomsaying thing. To your prior point, doom sells. But that's actually not really how that's meant. Because, for example, if it was doomy, then the train would stop. And so part of the nothing stops this train thesis is it's kind of a balance between... Basically, I'm saying on one hand, it's pessimistic because I'm saying they're not going to meaningfully fix the deficit anytime soon. It's very mathematically implausible that anyone's going to be successful in that. And as we've seen, there's been pretty abrupt pivots, and even the people that said they would now kind of backtracking. On the other hand, it means that they're going to keep the wheels on enough. I think that's true for the US. I think that's true for Japan, where it's also not going to spiral into some crisis in the next 3 years and stop in that way either. I think it's basically going to run hot for any sort of investing time horizon. When we're looking out 2 decades, that's a whole different world, right? I'm not trying to make 2-decade predictions, but I'm trying to look 5-10 years ahead. And basically that in that time frame, there's relatively low scenario probabilities for how we're going to do anything other than run hot for that period. Emerging market recessions and developed market recessions look different. So, for example, in an emerging market, you often won't get an unemployment spike. I mean, it depends on the type of recession they're having. But often what happens instead is basically a currency crisis. It's kind of like this inflation wave. And so everybody kind of feels poorer, and yet there's not really this big labor cycle change. It's more just imports more expensive. They're getting less per hour worked. There's an economic malaise that is happening, but the units are being treated differently. If you look at a lot of numbers, in many ways, 2022 was a recession in the US. For example, if you look at the misery index, which is unemployment plus inflation, that was basically a recession-level misery index, but it was more from the inflation side than the labor side. When you look at, for example, bank lending, what percentage of banks are tightening credit availability versus loosening credit availability? That 2022 year was the only time in modern history where we hit something like 40% of banks tightening at once and without a recession on the record. And again, I would say that was basically a recession. Most people were worse off that year than 6 months or 12 months prior. Yep. But it didn't show up in a big labor cycle change. It instead showed up in this kind of inflation wave where everybody's kind of a little worse off than they were at the sugar high of the stimulus because that delayed inflation hit and their wages weren't going up at the same rate. And so everybody's kind of taking this kind of shared pain. So in a typical developed market disinflationary recession, most people don't lose their jobs, but those that do are greatly impacted. Whereas in a more inflationary emerging market style recession, fewer people lose their jobs, but the pain is kind of spread through inflation. And so it's a different type of pain. And I do think that basically recessions going forward in the developed world are more likely to have some of those characteristics where some of the pain is felt more in monetary debasement rather than these kind of typical cycles we've been through. And part of that is because bank lending is less important or less a lower magnitude relative to fiscal deficits than it used to be. For most of the past, call it 50 years, net bank lending is a bigger dollar amount in a given year than fiscal deficits. With generally the only exceptions were maybe you'll see a 12-month period during recession where briefly fiscal deficits are bigger and lending has contracted. But now in this kind of period of fiscal dominance, even when we're not in a recession, fiscal deficits are usually bigger than bank lending. And so this is kind of this more background running hot. And so it's actually pretty hard to have the type of recession we've come to expect. But that doesn't mean you can't have periods of economic weakness or people kind of correctly feeling that they're worse off than they were the year before.
Yeah.
So I think those cycles are intact. I wouldn't say what I think the specific time frame is going to be. On average, I think it's somewhat of 3-year cycles, but it varies. And, I do think they tried a pretty aggressive tightening cycle in 2022. Basically, they decided that they kind of observed that the inflation pain was worse than anything else. So they had to get that under control, at least try to. So they tightened policy, they slowed down bank lending. There weren't any major new fiscal bursts going on in 2022 compared to what we saw in the prior 2 years. And so that was across the board a pretty contractionary year. But then the pain became so much that the entity started to bend around it. So, for example, UK gilt crisis in 2022 was an issue. At the same time, the US Treasury market didn't break the way that the UK's did, but ours became wobbly. Like, we had like record high move index, like meaning Treasury volatility. And over that year and then the next year, the Treasury Department shifted toward kind of an unprecedented issuance of T-bills as a ratio of their debt, which they normally only do in crises and recessions. But despite the fact that there was no official crisis or recession, they were shifting more and more toward T-bills rather than issue as much as they generally should have been doing on the longer end. And so that was kind of a softening of the Treasury, kind of offsetting some of the Fed tightening. And then in early 2023, when the banks ran into issues, they blinked. And so they gave liquidity provisions. And soon after, they slowed down and then stopped interest rate increases. So they kind of ran into the guardrails that they could do. And so some of these background forces, like the big ongoing fiscal deficits, slowly kind of overpowered some of those tightening attempts. So in 2023 and 2024, we got this like other kind of unintentional loosening of a lot of things. And 2025 has obviously been a shaky year because of all this tariff uncertainty, currency volatility, and things like that. But I still think we're in a sustained period of money supply running hot, nominal GDP running hot. Attempts at tightening are more about narratives and jawboning rather than anybody meaningfully cutting the deficit, doing anything that can really hurt banks. And so the kind of the error correction is normally toward when in doubt, liquidity is okay, and things tend to run hot rather than run into disinflationary collapse. So Japan's on somewhat of a different cycle. I think for Europe, somewhat of a shift there is that they've historically been reticent to do fiscal stimulus of various types. Japan's kind of in a constant state of fiscal dominance. The US runs pretty heavy fiscal spending, deficits on a regular basis. Europe's generally been more constrained, primarily because of Germany. But because of their defense situation and other factors, they've been increasingly, over the past several months, inclining toward, looking at more fiscal in the future. The market's kind of front running that, which potentially means, higher not nominal GDP growth and higher long-term interest rates. In Japan's case, they basically have such high public debt to GDP that their bond market is not really a free market. And when they try to do things like quantitative tightening, they try to get out of things like yield curve control, they face pretty significant issues because there's no end in sight to their ongoing deficits and there's no realistic fix for their public debt to GDP other than inflating part of it away and letting it kind of run hot and trying to keep nominal GDP growing in line with that debt. I'm less of a bear on Japan than some of the doomsayers would be because a lot of the problems they have with their public debt, the other side of it is they've run decades of trade surpluses and current account surpluses. So they have a huge stockpile of sovereign assets and private assets. And so as we saw, for example, a couple years ago when their currency was weakening sharply, they can sell treasuries or they can sell dollars to backstop their currency, potentially break short attempts. So they have a lot of ammo to really draw this out and potentially have, for example, make the Fed go back to QE because of potential dislocations in the treasury market before they would run into a true crisis. We've even seen some comparisons between Japan and Greece. That came up in the news lately, right? That Japan debt to GDP is now higher than Greece's was at the high point. But a key difference is, one, Japan is incredibly productive compared to Greece. And two, the debt is in their own currency, whereas Greece was subject to a currency that they didn't fully or even have substantial control over, whereas Japan does. And so they have a lot of different levers that they can pull to keep the wheels on the track for a lot longer, I think, than people expect. I think there are two things happening simultaneously. I think one, it just makes sense for balance sheets to have the best money. And so I think that's a more structural shift. That basically, if you're a business, instead of holding melting ice cubes, fiat currency, or instead of decapitalizing yourself, basically giving all your money back to shareholders as share buybacks or dividends, and purpose taking on debt you don't need, like Coca-Cola has like 40 or 50 billion in debt, despite being profitable every year for like a century. And the reason they do that is because why would you not issue 30-year bonds at 2% if you can? It's basically financial arbitrage. And so that's been the name of the game. These big, successful blue chip companies, they take out debt they don't need because they can and it's cheap, and they basically short into currency for 30 years at 2%, which is great. They're buying back shares, they're paying dividends. So Bitcoin introduces another thing you can do, which is hold a scarce asset on your balance sheet. So you're protecting yourself from debasement, but you're also not turning your whole balance sheet into liabilities and basically decapitalizing yourself as much as possible. When capital is not, kind of respected, all these companies said, well, we don't want capital then. And so this is a new tool to actually have capital. The other strategy, I think, on top of that is arbitrage, which is if this currency is going to keep weakening, we're then going to try to issue debt in that currency and buy this way better currency. You see this to some extent whenever you have like an emerging market currency crisis. There are companies there that say, well, we could take out bank loans in our failing domestic currency and buy dollars with it. That seems like a good trade. And then sometimes you'll see, for example, this is happening in Turkey, where they would then come in and say, well, if you're a business that holds dollars, you can't take out a loan in the local currency because we don't want you basically doing a speculative attack on our currency to buy dollars. That's kind of what's happening with these leveraged Bitcoin entities. They're kind of doing speculative attack on the dollar, buying Bitcoin. But of course, the dollar can absorb a lot bigger attack than a developing market currency. And so there are, I think, arbitrages that are happening, and rightly so, because when the opportunity is there are entities that are going to take it. And those that do it earlier get disproportionate gains. And then the question is, what percentage of them or which ones will nail the turn? Like when this eventually gets overdone, excessive, and dangerous, which ones will have the best risk mitigation in play to get through a bear market without having to liquidate at an inopportune time and otherwise just, knock it over their skis?